Hey, good afternoon, everyone. My name is John Jimenez, EVP of production here at Angel Oak Mortgage Solutions. Hope everyone's having a great start to their month of April. Today, we're going to do a everything cash out, whether it's HELOC seconds, close-end seconds, bank statement, full doc. We're going to talk all about cash outs and the huge opportunity out there for each and every one of you. Everyone keeps talking about inventory stacked up, but I think you can create your own little cash out refi boom. I'm going to introduce our subject matter experts here in about another minute. We'll let everyone log in and we'll get started. Oh, I really should have. I'll start the webinar off by hello, my friends. That's my Jim Nance. Welcome to the Masters golf tournament going on today. So I'm sure there's some what's it? People are distracted today, or a lot of bandwidths being used while people are watching the Masters on one screen and attending the webinar. So hopefully they'll give you a little break from watching the Masters here. Well, let's get started here. My name is John Jimenez, EVP of production here at Angel Oak Mortgage Solutions. I am proud and honored to have two subject matter experts, which I just saw a couple of days ago at the FAMP Broward Convention trade show. So I'm going to introduce Oscar Unco first. Oscar, please introduce yourself.
Hey everybody, my name is Oscar Ungo. I'm an account executive here at Angel Oak. I've been with the company for just over 7 years now. I'm out of Miami, and I'm looking forward to getting started on this 1.3 trillion opportunity of cash out opportunity that and mini refi boom, as John said, that we have here.
Yeah. And just a couple months ago, we had our sales conference, and Oscar was a top 10 producer there. So, Oscar, congratulations. And
Hey.
the next subject matter expert, Scott Grubel. Scott, please introduce yourself.
Yeah, good afternoon, everybody. Scott Grubel here, account executive down in the Broward County region in South Florida as well. Thank you for joining us today. I think we're going to go over some really good stuff, and I think some eyes will be opened.
Yeah. Yeah, and also at the sales conference a couple months ago, Scott was the number one producer for 2024 at Angel Oak. So, Scott, again, congratulations, and also broke the $1 billion club of originations just at Angel Oak with non-QM. So we have a lot of knowledge on this. I'm just here to make sure I don't get in trouble. So let's get started here. We're going to launch a poll, and the poll is going to be who has originated a second lien, whether it's a HELOC or a closed-end second, in the last 12 months. So while the poll's going on, I just want to share just some housing information. And Scott, Oscar, tell me if you can see that PowerPoint that I just pulled up. Probably
Not
not.
yet.
No,
Can
not
you?
yet.
Okay, sorry. Well, you people, while everyone is, while all the attendees are voting, let me see if I can change the share of my screen here. It's not letting me. All right. Apologize. All right. Well, anyway, I'll talk a little bit about it while people are voting. 40% of the homeowners own their homes outright since 2022. 63% have mortgages between 2.5% and 4%. 85% have rates below 6%. Homeowners are sitting on 35 trillion in home equity, and approximately each homeowner has 311,000 in equity.
So,
So,
John, if we
yeah,
combine those two statistics of under 6%, what's the total there? Total percentage of homeowners?
85%, Scott.
Total under 6%.
So that's those are generational rates, and I don't think we're going to see those rates probably for a very, very long time or even ever. So let's get back to the poll. Let's see. Sorry, guys. Uh, can anyone see the poll?
Yes, we can
Yes.
see
Okay.
it.
Can you tell me what the vote was?
We've got 73% no's.
Wow.
71% no's have not originated a second lien in the last 12 months. So
Wow.
there's a lot of opportunity there.
Yeah. So everyone, this is being recorded. You know, this is going to be interactive. Put your questions in the question queue. We'll get to them, I promise. But everything we're going to do today is on our website. So let's get started here. Scott, let's talk about the most popular of the second liens. Let's talk about, sorry guys, I'm screwing things up here. Sorry about that. Scott, let's talk about our bank statement HELOC loan.
Absolutely. So, to kind of go high level overview first, as you mentioned, John, you mentioned the statistics of the amount of equity that homeowners are currently sitting on. As you mentioned, I love the term generational rate, right? Most of these homeowners, almost all of them, are sitting on a first mortgage that they have set at a generational rate. They have no intention of refinancing that first mortgage, but they have all of this equity sitting in the property, and they're looking for opportunities and ways to tap into that equity without touching that first mortgage. Maybe it's to consolidate debt. Maybe it's to do some home renovations. Maybe it's to buy another investment property. Who knows, right? But they want to tap into that equity that's sitting in the property. And for us at Angel Oak, and for everybody on this webinar, as you all know, we cater to the non-QM borrower. So we're talking bank statement borrowers. We're talking investors, right? That's the community, the underserved community that we are here to serve. So our home equity line of credit product was rolled out to serve that borrower directly. This allows your business owners, your 1099 individuals to be able to tap into the equity in their property using their bank statements to qualify versus having to go full doc. Remember, these borrowers that you all may have done a bank statement loan over the last 5 years, again, they're locked into that generational rate on the first mortgage. They are probably in the same situation in terms of how they report their income as they were when they took out that first mortgage. So they can't go full doc. They're not going to qualify for a HELOC conventionally full doc. This is the only option available to them. To my knowledge, Angel Oak is the only non-QM lender offering a bank statement HELOC at this point in time. So this program is unique to us and it's very flexible. Let's dive into the details. As you can see here, guys, you only need a 660 credit score to qualify for a bank statement HELOC. Now, that 660 credit score will get you up to an 80% CLTV. However, we do go up to a 90% CLTV with a 680 credit score. Let's pause for a second. Let's think about that. 680 credit score, 90% CLTV. Guys, if you're doing a cash out refi today, where are you capped? Just about everywhere you go, 80%, right? So here, with a 680 score, you're taking this to a 90% CLTV. So we're really giving them the opportunity to tap into that equity. Loan amounts on business bank statements go up to $750,000. So, a lot of the loans we've done over the years for bank statement borrowers, the first mortgage when they purchase these properties, we see a lot of jumbos, right? The average loan amount for a bank statement loan for us historically has been very, very high, 600,000, 700,000, et cetera.
Scotty, just last month, the month of March, the average loan amount for bank statement loans that were closed was $730,000.
See, I love to hear that data because we run it on a monthly basis and it feels like it's constantly improving. It's your business owners, your 1099 individuals that are buying that $1 million, $1.5 million, $2 million home. So here we allow them to go up to $750,000 on this HELOC to tap into the equity. So it accommodates those buyers. On personal bank statements, we go up to $500,000. So again, a big chunk of equity they're able to pull out. If you compare those to guidelines on cash out, cash in hand, it's compatible, right? We do allow first lien HELOC. So if you do have a borrower that happened to pay off their first mortgage, they own the property free and clear, they're a bank statement borrower, we can do a HELOC for them in the first lien position. They don't necessarily have to do a first mortgage cash out refi. Minimum draw. This is a question we get asked a lot. Minimum draw. It's 80%. However, the borrower can take out the full amount at closing if they choose to. But at the closing table, they're going to take out 80% of the line that they've been approved for. They're going to hold on to that 80% for the first 90 days. After those 90 days, on day 91, they can pay back any portion of that they choose, and they can draw on that line as needed. So tons of flexibility there. As you can see here, guys, we do these on primaries, second homes, and investment properties. That's big. So on investment properties, we can do a home equity line of credit for your bank statement borrowers. We do offer the full doc option. It's there, it's available if you have a standard full doc borrower that for whatever reason is not qualifying for a conventional HELOC, we can get them done here under this program. Interest only payments during the draw period. So that's how these HELOCs work, guys. For example, if you have a 20-year HELOC, they'll have a 5-year draw period in which any of the funds that they draw from the line are repaid as interest only payments. So it provides them a lot of flexibility. And then after those 5 years, when you go into the 15-year repay phase, it'll become a principal and interest payment. No restrictions on how funds can be used. This is one of the really cool parts about a HELOC as opposed to a first mortgage, because a lot of times with the first mortgage, there's going to be restrictions on what you can pay off, what you cannot pay off at the closing table, if you are paying things off at the closing table, and there's restrictions on cash in hand, right? With the HELOC, there are none. So if your borrower goes to a $750,000 HELOC, they can pull that money and take it all out at the closing table, cash in hand, use it however they see fit. In terms of the terms, you can see there are a number of different options. So I used the 20-year as an example because it happens to be the most common one that we see. But as you can see, we do offer a 15-year term where it's a 3-year draw followed by a 12-year repay. We offer the 20-year term I mentioned, 5-year draw with a 15-year repay. And we offer the 25-year period where you have the 10-year draw with the 15-year repay. Now, the 25-year is only allowed on full doc, so please keep that in mind, which is why the 20-year is the most common one that we see. I like to call that one the sweet spot. So a ton of flexibility here, guys. I think the highlights you really want to make note of is obviously you can use bank statements to qualify, 90% CLTV, really strong. Your borrowers have the ability to access a lot of the equity in their property. You only need a 660 credit score to qualify this. So if I'm a loan originator, guys, and I put this out to my network all the time on social media and other ways, is I'm telling my network, look, guys, if you've closed a bank statement loan in the last 5 years, this is simple. Don't overthink it. Put in an automatic email into your CRM, shoot it out to those individuals, say, hey, we did a bank statement loan for you in, 22 years ago. And if you're interested in tapping into the equity in your property, I have a bank statement home equity line of credit for you. Send the email, sit back, let the phones ring. I'm telling you, I have loan originators that are doing it right now, and the phones are blowing up for them.
Yeah, Scotty, a couple of questions here. Michael, who I actually spoke to Wednesday, who's closing a loan with us on Friday. Unfortunately, Michael, Texas is a different animal when it comes to obviously cash out and HELOCs. We're not doing them right now on primaries in Texas. So, Michael, if you've got a second home, self-employed borrower, or investment property, so who's self-employed, we can do those all day long. A HELOC or closed-end second. So, but thank you, Michael, for your business, and thank you for closing a loan with us tomorrow. So appreciate that. A couple other questions before we get to Oscar and talk about closed-end seconds. Scotty, Jim's asking, no restrictions. We have a borrower would like to buy a second home.
No restrictions on how they're going to use the cash. Once they're approved for the line, as long as they draw 80% minimum at the closing table, hold that for those 90 days. There's no restrictions on how they use the cash.
Cool. All right, so Oscar, you're up. Let's talk about closed-end seconds.
All right. Well, one thing that you're always going to do when you sit with your client across the table and you are looking to pre-approve them to get some cash out, how do you determine whether to use a HELOC or whether to use a closed-end second? Question is, what is their goal, right? Scott mentioned it a few times. Flexibility. Flexibility is offered on the HELOC. You've got a client who can continuously draw over the draw period and get money out and put money back in, versus a closed-end second where you have a fixed secure payment over a period of 30, 20, 15, or 10 years. So determine their goal, determine how they want to pay that loan. Do they want to pay it in fixed intervals, right? Like any traditional loan? Or do they want an interest only payment? Do they want to continuously draw like you would from a credit card? So the main question there is, what is their goal? What payment do they need? And then how do they want to utilize those funds? Just before it slips my mind, Jim, you mentioned that you have a client that wants to use the money to go buy another property. Well, just before this call, I was on a call with a loan officer who set up a presentation with over 50 real estate agents. And part of the conversation was how you can teach your referral partners how they can market the ability to help their clients tap into their home equity, this locked up equity that we're referring to here, for self-employed individuals, to help them pull out all that wealth, all that equity that they've grown within their properties and their real estate portfolios, to go expand those portfolios and buy more real estate. So that may be another goal of your clients. Now, let me go over a quick high-level overview of our closed-end second mortgages. We also go up to $750,000 as a loan amount. Now, the max LTV on the program, unlike the HELOC, is 85% with a 740 FICO score. The minimum FICO score on the closed-end second is a 700 up to 80 CLTV. We can also lend on owner-occupied second homes and investment properties. The full doc option is offered, and I already mentioned that rates are 30-year fixed, 20-year fixed, 15 or 10 years.
Yeah, and Gayla, we're going to get to the interest rates. We're going to, I probably should have done a better job up front. We're going to talk about everything cash out today. We just obviously talked about the HELOC. Oscar just went over a high level view of the closed end second. We're going to talk about just cash out. Maybe some people just want to cash out and they're self-employed, but don't want a HELOC, right? Or cash out for an investment property. We're seeing a lot of that right now. So Gayla, I'm sorry, we'll get to our quick quote tool here in a minute. So Scott, let's bounce back. Keep the questions coming in. Scott, let's talk about our most popular program by volume. Let's talk about bank statements and highlight the cash out, the refi, and what you're seeing in the marketplace today.
Yep. So this is going to be obviously a cash out refinance of a first mortgage using the bank statement program. So in the event you have a borrower that is okay with refinancing and paying off that first mortgage, and maybe they want to pay off a bunch of high interest debt or just pull the cash for whatever other purposes, we can obviously do the standard cash out refi for a primary, second home, or an investment property. And on the bank statement program, we can actually go up to an 80% LTV for a cash out refi. So it's pretty aggressive and it's pretty strong. And the borrower can then just, obviously refinance that first mortgage, pull the cash out, pay off some things at the table if they'd like to, pay off any liabilities or debts if they'd like to, or just take the cash in hand and move on and go do what they're going to do with it. So it's all about providing options to your borrowers. Business owners that qualify for bank statements are entrepreneurial, and they know and understand how to leverage assets to their advantage, whether it's to expand their business or whether it's to further their investment portfolio. It's common for them to leverage their assets to do that. And the HELOC, the closed end second that Oscar mentioned, again, depending on what your borrower's goals are, do they want a line? Do they want the cash in hand? Or the straight bank statement cash out refi provides them all three options. One thing I do want to mention, guys, and we'll cover it later, is we actually offer a blended rate calculator on our homepage, free of use, don't need to log in. Anybody can log in and use it, where you can work a blended rate scenario. If you're paying off any debt and liabilities, you can work a blended rate scenario looking at home equity lines of credit or second mortgages to see which one is going to be more beneficial for your borrower. So again, we're providing you with the options and we're giving you all the tools to make it as easy as possible.
Yeah, Scott, so I just brought it up here. So yeah, it's really about, are you an advisor, right? And as Scott said, if someone has closed a loan with you in the last 5 years, they have a generational rate. They're probably not going to cash out of that rate. But maybe maybe they actually do need the equity in the house, and maybe they don't want. Scott, what would be an example? And I'm going to kind of lead you down this road from a standpoint of our HELOC goes up to $750,000, right?
Right.
But maybe they need more than that.
Maybe they need more than that. Right.
Right.
And
So
then, go ahead. I'm sorry.
no, you go ahead. Go over some of the loan amounts that we'll do for cash out
Yeah.
within.
On a cash out refi, if they do need to go higher on the cash in hand, we have the flexibility to do that. We have the flexibility at certain LTVs to go unlimited cash in hand. At other loan to values, we'll cap it at, I think it's up to 2 million. Let me actually pull up the matrix and we'll look at it directly, guys. So cash in hand here.
And stuff is always changing. That's why we got to look at matrices, because I think that was just a recent enhancement.
It was. We expanded this 100%.
Yep.
So it's unlimited at an LTV of 50% or less. So 50% or less, if your borrower wants $2 million, they can pull out $2 million from the equity in their property. Up to 50 to 60% LTV, it's exactly 2 million. So 60% and under, you want to pull out $2 million, you can. And then once we get over 60% LTV, guidelines state 500,000 cash in hand, but we do have flexibility to make some exceptions there.
Yeah, but go ahead, Oscar. I think you were going to say something. No.
I was just agreeing.
Yeah, no. So, but I think the great thing is getting to work with Scott or Oscar, and Oscar said it so well, is find out what your borrower needs, right? Find out what they need. Do they only need, or they need flexibility? Do they need the close-end second, or maybe they need more than $2 million, and their house is paid off and the house is worth $5 million. I mean, that's something that, again, find out if you've closed a loan. I'd even say go back further. If you closed a loan, any person you've closed a loan, we've been doing bank statement loans for over a decade.
Yeah.
I would search that database and find that out. So
they're fun. Go ahead, Oscar. Sorry.
I was going to add, just because we were talking about recent enhancements, one recent enhancement that I think that I've seen a lot of, that has made a big difference. In the industry, it's just been the norm that over years, if you're self-employed and you want a loan, you have to be in business for 2 years. But now we offer the flexibility of someone in business down to 1 year, as long as they've been in a similar line of work for 2 years.
That's
so
right.
On the bank statement program, you can get cash out up to 75% LTV, as long as you've been in business for a year in a similar line of work for the other two. So quick examples. You have an attorney who worked for a law firm and started their own law firm and has now had it open for 1 year. That person can get cash out on the property as long as they have a 720 FICO score. So just a big opportunity there for everybody.
Let's hit on some of the common questions we get when it comes to that self-employed borrower while we're here, right? So we're going to talk about debt service coverage next with Oscar and the cash out capabilities there. But Scott, would you allow someone with multiple business bank statements to calculate that income?
Absolutely. If you have a borrower that owns multiple businesses, we can look at the multiple businesses and that business's bank account, 2 separate bank accounts to qualify, for example. Maybe you have a borrower that has one business, but has 2 or 3 different bank accounts in which they have independent income or deposits coming in. Some people use one for just their merchant processing, and then the others for all of their, upfront retail transactions. So we can do that as well. There's a lot of flexibility there.
So Oscar, what if a borrower, 2 cases, basically, they, like what you just said, maybe they kept that W-2 job and are still self-employed for that 1 year. Would you be able to use that W-2 income for that borrower in the case of someone who's W-2 and is also self-employed?
It's a really common question, and yes, we can. We can use supplemental income. So even if they had a pension, Social Security, if they're collecting alimony, child support, we can use those.
Yeah. So, and as Oscar, stay on that. What if their spouse is W-2'd?
They can also be on the loan. We're not going to request tax returns. They just need to provide W-2s and pay stubs, and then we're going to calculate that income too.
Yeah.
The old hybrid loan.
Yeah. I mean, again, working, the beauty that I get every day is to work with brilliant people like Oscar and Scott who've seen so many scenarios. They're going to take you down the right path and what's right, most best for your borrower. So let's talk a little bit of Oscar. Let's talk about the debt service coverage, because which is what our most popular unit was. And let's talk about, what we're seeing, every day investors wanting to tap that equity in their investment portfolio.
Yeah, so DSCR has always been a hot topic, but we are seeing, I mean, a huge spike in the amount of units, as John said, on DSCR loans. And so demand for DSCR loans and borrowers requesting cash out. Now, remember that if someone is self-employed and they want to tap into their home equity and it's an investment property that they want to tap into, then we do offer the bank statement HELOC. We do offer the second, right? For those of you that are just joining us. But the DSCR program is also a fantastic way to get cash out on a property. And we can go up to 75 LTV. Now, for those of you who have not done DSCR loans yet, DSCR loan yet, normally when we ask that question, when we do have our DSCR webinar, we see about what I would say an average of 60% of the audience, what we say have today, John?
Yeah.
Right. So that means that there are about 40% who have not. So for those of you who have not, big opportunity. You've not missed the boat there. What does DSCR stands for? It stands for debt service coverage ratio. So DSCR, all that means is, does the property cash flow or not? So what are we looking at when we're looking at a DSCR loan cash out on an investment property? And how do you pre-qualify your customer? The first thing that you want to do is ask them, do you have a tenant in your property or is it vacant? Because that can impact your LTV, because it's going to impact the debt service ratio loan calculation, right? We're going to use the rent and we're going to divide that by the total housing payment. Now, shortly, we're going to show you how easy it is to, number one, get yourself a rate quote, and number two, use our DSCR loan calculator to calculate the DSCR. It's all very simple. The only thing that you need to know is you need to know what the insurance is, you need to know what the taxes are, and if there are any HOA dues. That's it. You're going to calculate your principal, interest, taxes, and insurance. And that's once you have your total housing payment, all you do is divide it by the current rent on the property, and that is going to determine your DSCR. So there are ratios that you should just know, keep as a mental note off the top of your head. Number one, the main ratio is 1.0 or 100%. What that means is the rent is covering 100% of our total housing payment. You're breaking even. And for that, we allow up to a 75 LTV on cash out. But what if the DSCR ratio or the rent doesn't cover 100% of our total housing payment? Does that mean that it's the end of the road for that loan? Absolutely not. We constantly say that this is a nearly bulletproof program. And the reason for that is because as long as your borrower in this instance has the credit, right, then you can structure your LTV to a point where, as long as they have the equity there too, they can still get cash out. They can tap into the equity on the property. So we allow ratios less than 1. The tier just down from 1 is 0.8. 0.8 represents 80%. The rent here will cover 80% of the total housing payment. And there we are fine at a 70 loan to value. But what happens if we're even below 0.8? There is no floor, but that's where we're going to cap the LTV at 65. And that even allows vacant properties. So if you have a customer who does not have a tenant in the property, it's an investment property and it's vacant, and they want to use a DSCR loan, we're okay with a vacant property at a 65 LTV. They can still get cash out as long as they have a 720 FICO score. So the opportunity is there for your borrowers to leverage the equity that they have in their homes to go buy more real estate, consolidate debt. If they want to go, maybe they want to remodel a home. So these are all things that these are all huge opportunities.
Yeah, and Oscar, and we see these come in like for the, this is also for a purchase. It's for the first time investor, right? As long as they own a home or their situation is explainable, is common for them renting in that area. But when we see cash outs, guys, I mean, these come in multi-packs, right?
Yeah.
So if you've done an investment property for a borrower, whether they have 1, 2, 10, I mean, we'll do a cash out on up to 5 or 2 million in exposure. But, again, 25% of everything we close here at Angel Oak is done with an exception. So Scott, talk about, the 1003 a little bit on that debt service coverage ratio.
Yeah, DSCR ratio, such an easy loan to get closed, such an easy application to take for you as a borrower, for you as a LO, and for your borrower. Basically, we do not want any employment information on the 1003. We don't want any income information on the 1003. You're going to leave employment and income completely blank, and then you're just going to fill out the rest like normal. In your real estate owned section, if your borrower happens to own a lot of real estate, we're looking for any real estate that they own individually in their name to be added to the REO, but you're not going to have to verify taxes, insurance, etc., because there's no DTI on these programs. There's no ratios whatsoever. So as long as the mortgage is reporting to credit, which it usually is, there's not much else that you have to verify. And to kind of take a little step back, one cool feature that we offer on both the bank statement and DSCR cash out refi is the ability to go interest only, right? So, just like we mentioned earlier, tapping into your database for, bank statement borrowers to pull out equity going with HELOC, same thing here. If you've closed an investment property, or if you've closed one with a DSCR program for any of your investors, you should be reaching out to them too, because one thing that investors are pretty savvy at is after they acquire the property, they're going to get that property rented, whether it be long-term or short-term, and they're going to realize what their monthly income is and where their break-even number is. And once they know what their cash flow is on that property, they know they can leverage that property, take the mortgage payment to a certain amount, and then use the cash, the leverage from that property to go invest in other properties. A lot of these savvy investors do this over and over and over again, and that's how they build their real estate portfolio. So you're adding value when you're going to an investor, a borrower, or a realtor and offering them these strategies. Back to what you said, John, it's about being an advisor, right?
Yeah.
Not a transactional LO, but an advisor.
And last year, what was the stat for the home value since 2019? And this is already a year old, so it's still probably even a little higher than that. Since 2019, the average home around the United States has appreciated almost 50%. I think it's 49.7%. 47.5%, and that was, a year ago. So that stat is still old. Oscar, talk about some credit scores for the debt service coverage ratio program and what you'll need, and up to what LTV, if you don't mind.
Sure. So the minimum credit score on the DSCR program is a 680, and that'll get you on a purchase, that'll get you up to 75 LTV. If you're looking at a cash out, that will go up to 70 with a 680.
Yeah. Let's go, now, Scott.
Yeah. Sorry to cut you off, John. Something I wanted to mention. The scenario that I gave earlier was using annual rent, but there is a huge opportunity. We know that short-term rent is ubiquitous across the country when we're referring to investment properties. And here in the DSCR program, we're talking investment properties. Not everybody has annual rent on a property. A lot of people are using properties to, collect income using websites like Airbnb and VRBO. And so for those borrowers, we can also use their short-term rent to calculate the income. We're going to use what's called a transaction history from that third party, whether it be Airbnb or VRBO, or maybe it's just a third-party company that manages the rentals. But we want to see the transaction history and at least 2 statements showing where the rent is deposited. And that's it. Well, there is no vacancy factor or a factor or percentage that we use. We use 100% of it. So we just average it out over 12 months, and we're going to use 100% for the rent. The max loan to value when we're using for cash out, when we're using short-term rent, is 70%.
Yeah, thanks, Oscar. And that's big. A lot of people are doing those short-term rentals, and that was a recent enhancement that we just rolled out. Or not just, it's been out for a while. But Scotty, you were on a panel. Tuesday, right? For condos. So talk a little bit about the condo market and what Angel Oak does for condos.
Absolutely. So condos are a huge topic in South Florida. We saw an article was published recently in Miami Herald that showed, I think it's 10% of the condos nationally are non-warrantable condos, but close to 60% of condo buildings in Broward and Dade County are considered non-warrantable condos. So if you're local here in the South Florida market, but again, applies nationally, there's a high chance your condo can be a non-warrantable condo. So what happens and how does this tie in? Well, we offer non-warrantable condos on all of our products and programs. For Angel Oak, a non-warrantable condo is a property type. It's not a program, right? So if your property happens to be a non-warrantable condo, there's no hit to the rate. It gets priced as a condo. There's no loan level pricing adjustment. There's no LTV hits. It is strictly just a property type. If your borrower's going bank statements, they can qualify under the bank statement guidelines. If your borrower's going DSCR, they can qualify under the DSCR guidelines. Our non-warrantable condo program, or I should say our property type, has solutions for just about every issue you might run into. So if it's an inspection issue, we don't ask about them. If it's an insurance issue, we go to 10% deductible on hazard. We go to 15% deductible on windstorm. Our coverage guidelines are laxed. If it's a reserve issue, we calculate our reserves differently. We look at the current year's budget, but we also look at what the HOA has in their current bank account for reserves, and we combine the two. If it's a litigation issue, as long as it's not a structural or safety related litigation, we can do the loan. So we have solutions for just about everything when it comes to non-warrantable. But what I wanted to tie in here, guys, is this is a cash out webinar, right? So what are you seeing most with non-warrantable condos? Assessments. And a lot of these unit owners are having a hard time affording these assessments. Well, guess how you can help them do that? Cash out. Whether it's a HELOC, closed-end second, cash out refi on a bank statement, or DSCR, we can help them tap into that equity using any of these products we just discussed to be able to pay off those assessments, ease their mind, stay in their condo that they love, live that beach life, whatever the case may be.
That's a great point, Scott. I didn't even think about the assessment issue and being able to get to that equity to take care of that assessment. That's brilliant. That's brilliant. Oscar, talk about, we're going to talk about some key features of debt service coverage ratio, and then we're going to talk about our rate quote and then how to get us a pre-qual and marketing also. So again, this is being recorded. This will be sent out before end of day tomorrow. If we don't get to a lot of your questions, we'll have your account executive reach out to you. So Oscar, a big feature for the debt service coverage ratio is, can you close in an LLC?
We can vest title in an LLC for both tax purposes and liability purposes. You're going to get that question often. And so the main question that you need to ask back in return is, what is your ownership percentage of your LLC? All parties on the LLC have to be on the loan. They have to qualify for the loan. If you have a client who happens to already have an LLC and maybe they already have other properties tied to it and they have a partner in it, but they don't want this person on this new loan, then we have no seasoning period for how long the LLC or S Corp or C Corp has been open. We just, they can just create a new one. And then in underwriting, we're just going to want documentation to verify that they own 100% of it.
Yeah, thanks, Oscar. I know we got 20 minutes left, and we want to show a couple of great tools and some underutilized resources that we have for them. So, Scotty, take me through the quick quote.
All right. Yep. So non-QM quick quote, as you guys saw, John was on our homepage, clicked on the non-QM quick quote, and was able to get right in here to our online pricing tool. Most important thing you guys will realize there, or you notice there, is that you did not require any credentials to get in here. This is open to the public. So you can come in here and price out any scenario you might have if you're on the line with a borrower and you're just curious about what a rate will look like. You're also going to come to this tool once you have a little bit more of a solid loan in hand and you want to submit a pre-approval to your Angel Oak account executive. This is how you're going to do it. So as you can see here, John's entering an example as a HELOC, second lien position. Second lien loan amount is $200,000. HELOC draw amount is $160,000. I'm going to pause right there for a quick second. Very common question we get asked that we did not cover on HELOC. And probably one of the most important ones to everybody on this call is, what do I get paid on, right? You get paid on the full loan amount, the second lien loan amount. And you can charge on borrower paid up to 3 points, just like you would on a first mortgage. You can also go lender paid. Now, just keep in mind on a HELOC, if you go lender paid, the borrower is going to pay the fee. Your lender paid comp is going to come out of pocket, because obviously there's not a rate to build it into. So they have to pay it out of pocket as a discount to Angel Oak, but you can go lender paid if you choose to. But you do get paid on the full amount. So as you'll see, John entered the credit score here, entered the CLTV 70%. I'm going to go ahead and enter your transaction type as a cash out whenever you're doing a second or a HELOC. We'll do this one as a 12-month bank statement program. Primary residence, U.S. citizen, 30-day lock, interest only. You don't need to change the interest only part, guys. System recognizes it's a home equity line of credit and it's going to be an interest only payment. And as you can see, there's your compensation type where you can change it borrower paid to lender paid. In this case, we'll go borrower paid. So you can see at the bottom, you're being priced here on a home equity line of credit at a 70% CLTV. It's letting you know we can go up to a 90% CLTV if needed. And the rate today is 9.5% with a 2% margin. So how does that work? HELOCs are based on prime rate, right? So it's the prime rate plus the margin equals the interest rate on a monthly basis. Your borrower would be locking in that 2% margin. Prime rate today is 7.5. 7.5 plus the 2 is how we're getting to that 9.5% rate. Closed-end second, as you can see, a little bit different. This qualifies for a closed-end at 70% LTV. You can go up to 85 CLTV if you'd like, but you're at a 10.625, and that's going to be a fixed rate. That's a standard closed-end mortgage fixed rate. Your borrower will get all of their cash at the table, as Oscar mentioned earlier, and they'll have a set payment based on that interest rate. If you decided you wanted to proceed, this looks good, and I want to send this to my account executive and get some income calculated on the bank statements and get myself a pre-approval, right? Our pre-approval as AEs is our version of AUS findings. Think of it as a DU or an LP, approved eligible. It's going to give you your pricing. It's going to give you your terms. It's going to give you any notes and findings that you need. So you would come in here, you'd select your rate, clicking one of the little circles there on the right, and then you'll go select option. In step 2, you have the ability to upload a 3.4 file if you have it buttoned up. If you don't, no worries, hit the next button. And in step 3, you'll fill out some information at the top, very general, choose your account executive, your company name, obviously your name, your NMLS ID, etc. And then you'll notice down at the bottom, you can put in the property address and then drag and drop your 1003, your credit report, and all of your bank statements easily with just one click of the button into the system. You'll scroll down to the bottom, answer a few questions regarding the credit history. There you go. And then you'll be able to hit that submit button. That is going to securely submit all of those documents directly to your account executive.
Yeah, so Scott, a couple things that we usually talk when we just talk about bank statements and stuff like that. You know, we're calculating that income for them upfront, whether it's a purchase, refi, cash out, doesn't matter. We're calculating that income for you upfront. A couple of other things, Scott, we didn't touch on, or if we did, I apologize, I missed it. Talk about the AVM.
Yep. So as you notice, it asked for the property address on this screen, and there was a reason for that. At certain loans of 80% CLTV and below, and loan amounts that are under 400,000 on a HELOC, we're going to run an internal AVM. We can use that internal AVM value to qualify the loan, meaning your borrower, you do not need to order an appraisal. Your borrower does not need to pay for an appraisal. That AVM is at Angel Oak's cost. So we do have that flexibility. If it's a loan amount over the 400,000 mark, or if it's a CLTV over 85, then in that case, we would need a full appraisal.
Yeah, great point. And again, you know, Scott, how long does it take for you to, let's say bank statement, how long would it take you to do a pre-qual up front? You know, how long does it take you to do a pre-qual?
If the pre-approval comes in earlier part of the day, usually before noon, we can usually get them back same day. If not, the standard turn time is 24 hours. When you guys hit that submit button, the AE gets a notification that a new pre-qualification has been submitted. We will then go into the system, take a look at all of the documentation, and submit the file into the bank statement review team to get those bank statements calculated.
Yeah.
So we're typically able to get that income calculation back within 24 hours, review the rest of the file, and send you back our findings.
Yeah. And so, Oscar, how long does it take you to do a debt service coverage ratio pre-call?
As long as we have everything we need on the 1003 and credit report, it takes us likely less than 15 minutes.
Right.
We do get several a day, but we'll get it done the same day as long as we have no follow-up questions.
You guys get a lot a day. So, uh, all right, Oscar, let's talk about marketing, right? Because we have all these great tools. We have great AEs. We've got a blended rate calculator. We've got, a quick quote tool that you can get quotes any time of day. And as Scotty said, you don't need login credentials there. So, Oscar, let's talk about the most underutilized. We talk about innovative solutions for underserved borrowers. Let's talk about an underutilized marketing portal. So let's do this.
Yeah. So, I mean, look, you can say that the focus of today's conversation, essentially, as Scott mentioned early on in the call, is that what we're offering here is the low-hanging fruit. You need to go through your pipeline. For those of you that joined us late, you need to go through your pipeline and look at all those bank statement loans that you closed in the past and contact those customers. Do not underestimate their demand for cash or their need for cash. So that is the low-hanging fruit for you. But Scott also mentioned early on the call, you definitely want to reach out to everybody in your contact list and market as much as you can. And we are making it very easy. You do not need a marketing team. You yourself can be your own marketing team. You don't have to pay anybody for this. All you need to do is get yourself login credentials and visit our website. John, did you want to mention?
Yeah, we talked about the equity everyone's sitting on. I'm going to go over some other stats here about like Oscar. You know what, Oscar? Do you have those stats because you did it so well? You were on the other panel at that trade show for Second Lien. So if you have it in front of you, if you don't, I've got it right here. So you
I
want me to
do.
go
I
through it?
do. So for those joining us a little bit later, we're just going to go over really quick numbers, big numbers here, and the opportunity that there is out there in the market for cash out. We started by mentioning there's 30 trillion in home equity right now, 30 trillion out there in home equity. U.S. homes have appreciated 47.5% on average since 2019, right? So I think that on the low end, the average person is sitting about 300,000 in home equity. So
Yep.
those are just a few opportunities. Now others, and where you come in to help, other things that are happening, which is what makes this market where we see the opportunity in this market. And every market presents itself with an opportunity. And we're seeing a mini refi boom, as we said earlier. And the reason for that is because consumer debt. Consumer debt is at an all-time high. Credit card balances here are at 1.8 trillion, with the average interest rate on credit cards being 27%. And Americans paid over 120 billion in credit card fees alone.
That's
So
fees. That's not like the debt. That's fees.
that's fees.
That's
Yes.
crazy.
Well,
Crazy.
people are in need for cash now. And
Yep.
just because, as we said, about 80% of rates are at 6%, that does not mean less than 6%. We know that there are plenty of people there that don't want to touch that first mortgage. So you want to make sure that you get yourself login credentials to our marketing portal. We talked
Right.
about locked up equity and the opportunity that there is that we offer for self-employed borrowers to use bank statement HELOCs to tap into that locked up equity. And you have the keys to help them do that. So all you need to do is go to our website at angeloakms.com. And then once you log in, you can plug into our marketing portal. So just to do that, you have to click on broker login.
Sorry, a little slow typer here. Can you guys see this?
At
We
least,
see the web page, the home
yeah,
page.
right now I'm looking at the homepage.
Oh,
Mhm.
so okay, sorry. I've got to share a different share.
As we go into the portal
Thank
here,
you.
though, What Oscar just what it's it's so simple. It's right in our face. We don't need to overthink this. What Oscar just described is a massive dislocation, right? You have record levels of debt, credit card debt in this country, yet record levels of equity. The equity can take care of the debt. They just need the avenue to tap into that equity, and that's where everybody on this call can step in.
Yep. And you don't need to reinvent the wheel. We've already come up with everything for you. So you can log in easily. If you do not have logins, if you do not know who your account executive is, there's a chat box. Just ask us to get in touch with you. We'll get you in contact with your account executive. And this way you can get yourself set up with some login credentials. Very easy to do. Now, once you do log in, all you have to do is go to the dashboard, click over marketing portal, and you can get started by looking at the flyers page. So once you click on flyers, we have a plethora of flyers here for you on every program and transaction type, right?
Wow, plethora.
So the moment that you click on one of the flyers, let's say if we click on Bank Statement HELOC, for example, and now when you log in, this is going to be exclusive to you. It's your login. Right now we are in the training portal, but you click on Bank Statement HELOC and it's going to open up the flyers page. On the left-hand side, you're going to have the option to fill in your information. You're also going to have the ability to upload your photo, and you're also going to have another option to upload your logo. And what we often see as well is co-branding, right? So here's what one of those flyers looks like. And the moment that you have finished filling in your information, you do not need to exit. All you have to do is click download at the very top, and it'll download to your preferred folder on your desktop. You can also click the drop-down feature there and choose any other program or transaction type. This way your information auto-fills, and you just download that flyer as well.
Yeah, we're in the test portal, so it's taking obviously a little longer. So that
Yeah.
won't be your issue there. So
That won't be your experience. But
yeah.
aside from the marketing flyers, we have plenty of content, right? Whenever we do some presentations, everyone asks about content. Do you have any social media images you can provide? And the great thing is that our marketing team has already set those up so that the dimensions are the correct sizes for any website, any sort of application that you're going to be using. The most popular ones today being Instagram, Facebook, LinkedIn. As you can see, they're already labeled for you, covering transaction types and who your target audience is. So if you're going to be targeting borrowers, and this call is primarily, for borrowers, then for your clients and borrowers, then all you need to do is copy and paste the caption that's already been pre-written, right? Now, let's say that you happen to be promoting other transaction types like a purchase on our other programs. Well, then we have the captions and the descriptions already written for realtors, if realtors are going to be your target audience. So no need to reinvent the wheel. We have the dimensions already ready and the content for Facebook, LinkedIn, Instagram, Pinterest, as you can see. The other,
Scotty,
go ahead.
go ahead, Scotty. I don't know if you want to jump in here. I know you do a lot with your broker communities and do a lot. Let's talk about. Sorry, Oscar. I think I counted here between the flyers and these social media posts. It's almost like 83 or 87 different ways you can market yourself. I mean, you could do basically almost do one every other week.
Yep, absolutely.
So Scotty, I know you do a lot of these presentations. I know you've had a couple of brokers really, really customize these. So if you want to kind of go over this.
Absolutely. So there's a PowerPoint presentation, realtor presentation you guys can see here. This is 100% customizable. And we even have a flyer where you can promote an event. So let's say you want to organize an event, invite a bunch of your realtors out. We're giving you the tools to promote it with the flyer. You can blast email that to your database or put it all over your social media channels, invite them all out there. We're giving you the PowerPoint deck to do that presentation. That PowerPoint deck is designed for you as a loan originator to be presenting to a room of realtors. It makes no mention of Angel Oak anywhere. It's just you presenting the non-QM data we just went over to your realtors. And what better way to capture your realtor's attention, right? They know all about LPDU. They know all about agency, conventional FHA. When they start hearing about DSCR, bank statement HELOC, non-warrantable condos, interest only, these are the things that pique their interest, right? So lead in with this presentation, fill the room, and then you can hit them with all of the other data you have, all of your other products and programs. But what's cool about this deck is it's 100% customizable. So I have an account, few accounts actually, that have downloaded this presentation. They've invested the time into customizing the entire presentation. You can delete pages, you can add information. They put their logos on every page, their contact information on every page. They customize it with their colors for their logo for their colors and their branding. And now they've shared that with all of the LOs within the organization. So every LO can go out there and present to their referral basis. They're having a lot of success. I can tell you firsthand because I, as an account executive, go out and present with them at these presentations, which any of your AEs throughout the country will do for you as a service.
Yeah, and it's powerful. One of the things we were talking about bank statements, and Oscar, I know you do this a lot. 9% of the loans we close using our bank statement program are actually realtors. Yep. So if you get 12 realtors in a room, the odds are you're going to close one of their deals. And if it's not on a bank statement, I can assure you it's going to be on a debt service coverage ratio. Oscar, throw in a couple of other things that you've done during some of your realtor presentations.
Well, yeah, on that topic, we're all in sales. So we're constantly growing our networks. And I promise you that if you're growing your network, you definitely want to reach out to your current referral partners. But if you're working and growing your network, which we all should be, well then I promise you, not a single person is going to say no to have a sit down with you to teach them how you can help them make more money. And so this is really what this is all about. And teaching somebody how they can help let's say you're reaching out to a real estate office, right? And you tell them that you're going to teach them how they can help one non-QM buyer a month, right? All you need to do is take the average worth of a home in that area, what their average commission may be, multiply that over 12 months, give them a phone call and say, hey, I'm going to teach you how you can earn X amount a year by helping one person per month. I promise you, no one is going to say no to that conversation. In fact, they should take you out, right? So
Oscar, 68% of the people that took the poll here of our attendees had not originated a second lien in the last 12 months. And you said it when we DSCR, 60% people. So the opportunity out there is incredible for all of you. So hopefully, we've given a few tools here today, and you've seen how professional Scott and Oscar are. Could you imagine walking into a room of realtors with Scott or Oscar and having them present on your behalf? And that's what they will do, whether it's in person, on a Zoom, webinar, whatever. So, let us help you grow your business. And I would just challenge everyone on this call to use this portal. And if you're not signed up with us, get signed up. Oscar, anything in closing?
In closing, we talked about all the opportunity out there. And what do we say, John? Evaluate the cost. This is absolutely free, but what's the cost of not doing it?
Yeah, losing a deal to a competitor because these deals are getting done. So, Scotty, anything else?
Yep. In closing, I hope everybody pulled some value out of this webinar. Our goal at Angel Oak is to provide loan officers with all of the tools you need to be a trusted advisor to your customers, products, programs, and tools, as you can see here in the portal. Our goal, and I can speak on behalf of every AE at Angel Oak, our goal is to be the first company you think of when a non-QM loan hits your desk. We will earn that right. Just give us a try on any one of these products and programs. And lastly, to stay up to date with all of these changes and our enhancements, please follow Angel Oak Mortgage Solutions on LinkedIn, Instagram, Facebook. We're on all social media channels. That's going to be the quickest way for you to stay up to date on everything we have going on.
Great point, Scott. Great point. And in closing, I just want to thank everyone for attending here. And again, this will be sent out before end of day tomorrow. It's an honor Scott, I mean, we didn't even talk about this, between the three of us just here at Angel Oak have almost 30 years of experience. So it's crazy. It's crazy. So for those who have closed loans with Angel Oak, thank you for your business. For those of you who haven't, hopefully you feel you could trust us with each and every referral source that you have. And Michael, I know you asked the first question here today, and I know you're closing your loan tomorrow. Thank you for trusting Angel Oak with your business, and hope everyone has the rest of a great day, rest of a great month, and look forward to seeing you on our next webinar. Scotty, Oscar, love you guys, man. Appreciate it.
Love you
You all.
too.